potentially leading to a sharp decline in demand. This could result in job losses in export-oriented industries and put pressure on Chinese manufacturers to either absorb the cost of the tariffs or seek alternative markets. These short-term challenges could serve as a catalyst for China to accelerate its transition towards a more balanced, consumption-driven economy. This shift, while potentially painful in the short term, could strengthen China's economic foundation in the long run. To offset the potential loss in export revenues, China might be forced to stimulate domestic consumption more aggressively. Chen views this as potentially the best tool for China to weather the impact of U.S. tariffs. The disparity between U.S. and Chinese domestic consumption, 70 to 80% versus 60% of GDP, respectively, highlights the potential for growth in China's consumer market. If successfully tapped, this could significantly reduce China's dependence on exports and create a more resilient economy. Measures to boost domestic consumption could include tax cuts for consumers, improvements in social safety nets to reduce precautionary savings, and policies to increase wages and household income. While China has previously retaliated against U.S. tariffs with its own import taxes, its options for countering Trump's proposed 60% tariff are limited. This limitation stems primarily from China's dependence on U.S. technology imports, particularly in the semiconductor industry. Chen highlights this dependency. China imports so much computer chips from NVIDIA, Intel, especially Qualcomm. Those products are what China needs, so China cannot produce internally. Imposing retaliatory tariffs on these crucial imports would effectively be self-harmful, potentially slowing China's technological advancement and hindering its ambitions in areas such as artificial intelligence and 5G technology. This technological dependence underscores one of China's key vulnerabilities in the ongoing trade dispute with the United States. China might attempt to shift some of its agricultural imports away from the U.S. to countries like Brazil and Russia. However, this strategy would not fully offset the impact of U.S. tariffs and could potentially lead to higher costs or lower quality for Chinese consumers. Moreover, completely replacing U.S. agricultural imports, particularly for products like soybeans, would be challenging due to the sheer volume of trade and the limited capacity of alternative suppliers. Paradoxically, Trump's protectionist policies could have unintended consequences that benefit China in the global economic arena. The Biden administration has pursued a policy of economic decoupling between the U.S., Western Europe, and China. Trump's aggressive stance towards traditional U.S. allies could potentially reverse this trend. Chen suggests, if Trump makes the EU and NATO member countries upset, that makes it more possible for Germany, for France, or Italy, or even the UK to warm up more with China on the trade front. This potential realignment could provide China with alternative markets and strategic partnerships to offset US pressure. European countries, faced with uncertainty in their relationship with the US, might be more inclined to strengthen their economic ties with China. This could include increased trade, investment, and technological cooperation, potentially undermining U.S. efforts to isolate China economically. Faced with restricted access to U.S. technology, China might double down on its efforts to achieve technological self-sufficiency. The Chinese government has already initiated programs like Made in China 2025 and invested heavily in research and development across various high-tech sectors. The additional pressure from U.S. tariffs and technology restrictions could accelerate these efforts, potentially allowing China to emerge as a more formidable competitor in key industries in the long run. While Trump's tariffs are intended to protect American interests, they could significantly impact U.S. consumers. The National Retail Federation has released findings estimating that a 60% blanket tariff on Chinese goods could cost U.S. consumers between $46 billion and $78 billion in annual spending power.